Swayam Prabha. Digital India. Educated India.
Hello, Namaste. I am Dr. Diksha Munjal Shankar. I teach as an assistant professor at the Faculty of Law, University of Delhi. Today we'll be discussing the fifth lecture and starting out with the heads of income. So if you recap, in the previous lecture, we had discussed what are the different heads of income. And from this lecture onwards, we will be exploring each of these heads. So let us start with the first head, that is the head which is salary. So when we look at this term salary, we usually think that whatever job we might be in, whatever service we might be in, whatever we are getting in hand is a salary. Or let's say, for example, somebody gave us some work on contract basis, and as a result of that, whatever we are getting is salary. However, for the purposes of taxation, we do not deal with salary the way we usually understand it. So, this lecture will help us understand when is it that we are supposed to consider a particular amount falling into our hands as salary or not. So, when we talk about this head salary, section 15 to 17 of the Income Tax Act deal with the provision of salary. So, we will look at the chargeability, what is the meaning of salary, and for that we will be looking at first section 15, which is the charging section, section 16, which talks about deductions, and section 17, which tells us about different definitions, first of salary, second of perquisites, and third of profit in lieu of salary. So when we talk about salary, we require that there is an employer-employee relationship. So an employer-employee relationship is a prerequisite. If there is no employer-employee relationship, then we cannot say that whatever you're getting is a salary in your hand. So coming to the slide, employer-employee relationship is a perquisite, and if the employer-employee relationship is there, then whatever is received by the employee from the employer, it will be seen as salary, including gifts. So we are saying if there is an employer-employee relationship, then whatever you are getting from your employer as an employee, that will be seen as salary, including gifts, right? So there are certain situations wherein we might be faced with this question whether or not a person is receiving salary or not, right? So what is the first thing that we are going to look at? We are going to look at whether or not there is an employer-employee relationship. Now, to be able to find out there is an employer-employee relationship, we will actually have to first check what are your terms of employment. So when we know what your terms of employment are, then only we can say whether or not there is an employer-employee relationship. And how do we see this concept of terms of employment? We will see whether or not you have got a contract of service or you have got a contract for service. So what is a contract of service? Contract of service is one wherein the employer has a lot of control over the employee. That means the employer actually decides when is it that you're going to come to work, when is it that, how is it that you're going to carry out your work, when is it that you can go back. So there's a lot of control that is maintained by the employer over the employee. That is when we say that the employee has a contract of service. However, if we contrast this with contract for service, over there, the employer does not have too much of control over the employee. So let's say, for example, you are given a task and the employer says that, well, this is your task and you have to finish it in these many days. But whether you finish it, let's say, for example, the employer said that you need to complete this task in 15 days. Now, whether you complete it in 15 days or whether you complete it in 5 days, that is clearly up to you. There are no further conditions attached in terms of how you are supposed to do this work, when you are supposed to do this work. This is the time you have to come to the office. This is the time you go back. There is no such control that is maintained. Then we say that you are enjoying a contract for service. Now, only when you have a contract of service with your employer, then only we can say that there is an employer-employee relationship. So, for an employer-employee relationship to be there must be a contract of service and not a contract for service. But what happens in case of contract for service? So, I am saying that in case you have an employer-employee relationship, what you are going to get in your hand will be treated as salary, right? But what if I have a contract for service? Then also I am earning. Then where does that income go? That income will go under the head income from other sources and not under the head salary. Okay. So let's say, for example, you have a director working for a particular company and the director is getting this sum of rupees 50,000 per month from the company. Now, when this director is getting this amount, we don't know whether or not this director is an employee or not. And how do we find that out? We will have to find that out first by understanding what are the terms of employment, and sometimes we will have to read it together with the articles of association of that company as well. So, whether or not there is a relationship between the director and ABC Limited of employer-employee will determine whether the director is getting a salary. So, if no employer-employee relationship is there, then the income will go to the head income from other sources, right? So, this becomes your new head of income, wherein because you are getting an amount which is not a salary, right? Because there is no employer-employee relationship, therefore, this amount will get into the head income from other sources. Now, if you look at the example of a partnership, what the partners get in a partnership would be subject to tax under the head profit and gains of business or profession. So, when partners are there, partners are not employees of each other. We cannot say this one is employed under this one is employed under this. That is not happening. And when that is not happening and you're still getting some sort of remuneration, this remuneration will not be treated as salary because there is no employer-employee relationship. Instead, this will go under the head PGBP, which is profit and gains from business or profession. So, now let's look at the chargeability. So, section 15 is the charging section of salary. What do we mean by charging section? By charging section, we essentially mean that, well, if section 15 was not there, then any income which would have the characteristics of a salary would not be subject to tax. So, every head of income has got its own charging section. That is the section which actually provides the basis for the purposes of taxation to actually start out. Now, over here, section 15 is the charging section, and it provides that salary shall be charged to tax on either due basis or on receipt basis, whichever is earlier. And third, in case of arrear of salary, you will be charged to tax on that also, but then that is subject to section 89 clause 1. So, section 89 clause 1 will provide you some sort of a rebate. Let's look at what do we mean by due and receipt basis. So, let us say this particular table over here, wherein it has been provided that you are getting a salary at the rate of rupees 1000 per month, okay? And in year 1, you are receiving 15,000 as your salary. So, if you are supposed to earn 1000 per month, how much of salary are you supposed to get at the end of the year? 12,000, right? But over here in year 1, you have received 15,000. Why? Because you've received some salary in advance. And then because you are supposed to receive 12,000, which is the amount that is due to you, you are actually only supposed to receive 12,000. But what happened? You received a salary that was higher, right? So now the salary that you've actually received is 15,000. So what are we going to impose tax on? We are going to impose tax on 15,000. Why? Because we are saying that we will charge you to tax either on due basis or on receipt basis, whatever is earlier. So while you were supposed to get 12,000, instead you received 15,000, and because your receipt came earlier, therefore you will be charged to tax on 15,000 rupees. Now, we are talking of 15,000 rupees in the first year, right? Now, in the subsequent year, when the next year starts, again, your salary has not increased and you are earning at the rate of rupees 1,000 per month, okay? So now you are going to get only 9,000 rupees. Why? Because extra 3,000 had gone off over here, right? So that came out through in year 1. And now you'll have to adjust this 3,000 over here. So obviously your employer is going to pay you only 9,000 now. So the amount that was due to you was now 9,000. And you actually received also 9,000. Your employer did not give you anything extra. And now what are you supposed to pay tax on? You are supposed to pay tax on 9,000, not 12,000. Why? Because in the previous year, in year 1, you had already paid tax on that amount of 3,000. And therefore, I hope that this example clarifies what do we mean by due basis or receipt basis, and whatever comes earlier in our hand, we are going to impose tax on that. So the next section, which is section 16, talks about deductions. Now, if you recall, in our previous lecture, we had discussed that there are going to be different heads of income, and every head of income will have its own unique set of deductions. So if you recall, I had drawn up something like this, that you've got salary, and then you've got deductions within salary. Then you've got house property, and you've got deductions within that. You've got PGBP with deductions within that, so on and so forth, right? So now what we are going to look at are the deductions under the head salary, not the deductions which you get once you have computed your total gross income. We are not looking at those deductions. These are deductions which are unique and particular only and only to the head salary. So section 16 provides for deduction for income falling under the head salary. The first deduction it talks about is that of standard deduction. So standard deduction is provided for in section 16 clause 1a, and over there it is provided that it is supposed to be rupees 50,000 or amount of salary whichever is lower. So let's say, for example, you've got 50,000 as your salary. 50,000 is your overall salary, right? And then we are saying that you're going to get standard deduction on 50,000, right? So you already are getting in hand 50,000, right? The Act is providing for your deduction at the rate of 50,000 as well, right? And they're saying whichever is lower. So over here it means exactly the same amount, and therefore you are not liable to pay tax because your entire amount will go off as standard deduction in itself, right? What if you are getting an amount of 10,000 rupees annually as salary, and then the legislation says that, well, we are going to give you standard deduction of up to 50,000. Then obviously, because you are earning much lesser than the threshold, than the standard deduction threshold, you will not be liable to pay tax, okay? And now, let's say, for example, you are earning 3 lakh rupees, and obviously, the standard deduction remains the same, which is 50,000. How much are you going to pay tax on? You are going to pay tax on 2.5 lakh. Why? Because 50,000 will not be subject to tax at all courtesy the fact that, it is a standard deduction. Let's move at the next one, which is entertainment allowance. So section 16 clause 2 provides for entertainment allowance, and this particular deduction is available only to government employees, and that too only if it is a part and parcel of the entire component of salary that they're getting. So not every government employee is going to get this allowance. If they get this sort of an allowance as a part of the salary, then we will talk about this deduction. Otherwise, it's not applicable. So it is available only to government employees, and it is seen as part of the gross salary, but government employee will get the deduction. Non-government employees will not get any deduction for such an allowance. So when we look at allowances as a concept, we will see that there are some allowances which are made available to certain set of people within even an organization, or if you see across organizations, there might be certain allowances which are available in let's say employment A, but the same set of allowances are not provided for an employment B. So if you switch jobs, you will think that, oh my God, I was getting all of these allowances in employment A, but now I'm not getting it in employment B. So allowances are something that are very, very subjective. So the third thing that we will look at is professional tax or employment tax, which is provided for in section 16 clause 3. In case any amount of professional tax is paid by the employee or by his employer on his behalf, then this amount completely as a whole is allowed as a deduction. So what is this professional tax or employment tax? So at times we are in certain sort of professions where we need to go and pay out some amount to keep our qualification intact, right? So let's say, for example, you are a lawyer. Every year you will have to go and pay some amount to the bar association with which you are associated to keep your association with that particular bar association current, right? Now for that you will have to give out some amount. This amount either you are paying, or let's say, for example, your employer is paying on your behalf. But whoever is paying, whether you as an employee or your employer, this amount will get absolute deduction. Then we look at section 17 clause 1, which defines salary. And when we look at this term salary, we include many components under it, right? So let us explore those. So section 17 clause 1 defines salary and includes the following components as constituting salary: basic salary, wages, annuity, pension, gratuity, provident fund, leave encashment, profit in lieu of salary, perquisites, allowances, bonus, commission, advance salary, and all of these put together then go on to constitute what we know as salary. So over here, if you see, there are certain things which will give you an idea that you are not in employment anymore, right? So if you look at the example of pension, when do you receive pension? You receive pension only after you have retired, right? But what are we saying? That this constitutes salary. So can we say that a person who has retired is still receiving salary? For the purposes of taxation, yes. Why? Because there was an employer-employee relationship, and as a result of that employer-employee relationship, because you had reached the age of superannuation, that means the age of retirement, now you are continuing to get it as an employment benefit that perhaps you also contributed to while you were in service. And therefore, as a result of that, the pension also that comes into your hand will be treated as salary under the head salary. So the first component is of basic salary. So usually in a salary slip, a very typical salary slip, you will see that there is a basic pay or a basic salary, right? Over and above that, and in addition to that, you get a lot of other things, right? So we will look at that, but for now, let's look at wages. So when we look at the Income Tax Act, it does not differentiate between salary and wages. If you look at the very broad difference between salary and wages, in case of salary, we are looking at those jobs or those professions wherein you are doing some sort of work which has got pen and paper work attached to it. But when we are talking about wages, we are talking about usually those situations wherein people are carrying out their work using human labor, right? So there is perhaps you've got unskilled laborers, right? Whatever they are getting it as wages. So for the purposes of taxation, there is no distinction whether you're getting a basic salary or you're getting wages. Both of these are to be treated as salary under this particular head. Then next, we have annuity, then we've got pension, then you've got gratuity, provident fund, leave encashment. We will look at profit in lieu of salary in a bit of detail. We will look at perquisites. We will look at allowances. Then we've got bonus. So if you do something great for your employer, you'll probably be awarded with some sort of a bonus. That would also be seen as a part and parcel of your salary. If you're working in an employment wherein you earn a lot of commission because of, let's say, liaising with different clients or getting more work for your employer, and you're getting some sort of commission, that commission would also be treated as a part of your salary. And then of course you've got advance salary. So let's say, for example, you were supposed to get an amount X, but because you have received amount X plus an amount that is over and above that as an advance, that would also constitute your salary. So next we move on to profit in lieu of salary, so which is provided for in section 17 clause 3. So what is this profit in lieu of salary? Profit in lieu of salary is basically one wherein you are getting some sort of money in your hand, but that is coming in place of your salary. So when we say profit in lieu of salary, that means we are getting some sort of an amount coming into our hands, and that is coming in place of our salary. Technically, salary should have fallen into our hands, but that did not happen, okay? And in place of the salary that we were supposed to get, we're getting something else. So over here it's stated that any compensation due to or received from any person before joining or after the cessation of employment would be treated as profit in lieu of salary. Now, let us say, for example, you joined an employment in the year 2000, right? And then in 2005, you were supposed to get some sort of a raise, okay, which did not happen. You kept waiting. The year 2006 came, you again expected the raise, it did not happen. And then finally, in the year 2007, you go and you file a case against your employer. And as you know, the court will take some time to come to its verdict. And then let's assume in the year 2010, the court says that, well, okay, this person was supposed to get a raise from 2005 onwards. Now, because you filed a case in 2007, your services were terminated, okay? And the verdict came out in 2010, wherein the court says that not only are you supposed to get the money that you were entitled to, but you are also to be reinstated. And that there was no ground for termination of your employment, right? Now, if you look at employer-employee relationship, employer-employee relationship was absolutely intact till 2007, right? Till this point, we can say that yes, there was employer-employee relationship. But now, from 2007 onwards, there was no employer-employee relationship, and rather, when the court came up with this verdict in 2010 that the person needs to get his dues and has to be reinstated, then there was obviously this gap between 2007 and 2010. When you're going to get reinstated, when you're going to get that amount in your hand, that is not going to be constituted your salary. Why? Because there was no employer-employee relationship. For something to fall under or to be said and considered as salary, there must be an employer-employee relationship. But over here, because there was a termination of employment, right? There was no employer-employee relationship, and because you are getting compensated for that, that amount would now be considered as profit in lieu of salary. Next, any amount due to or received by any person by an employee from his employer due to termination or modification in terms of the employment would be treated as profit in lieu of salary. So let's say, for example, you have joined employment in 2005, right? Your employer told you that, well, in 2007, I will give you some sort of a raise. That did not happen. Again, in 2008, you went and you asked, what happened to my raise, right? Nothing happened. And then nothing happened. In 2010, you get a raise. And then you keep looking forward to a raise. And then finally, in 2015, you get a raise. Come 2020, COVID has hit and you were supposed to get a huge jump in your salary, right? But now because COVID came and this huge jump could not be given, you could not get this sort of a salary anymore. And rather, the employer says that, well, COVID has hit, I don't think I can keep you in employment also. So what do we do? So the employer says that, listen, I thought I will terminate you, but rather I will keep you, but I am going to modify your salary, right? So whatever you were earning in 2010, that is what we are going to come down to. So now you will earn whatever you were earning in 2010. So if you want to remain in employment, continue with the salary that you were getting in 2010. Otherwise, you are free to leave. Right? Now, whatever call you take as an employee, that is really up to you. Because if you want to go ahead with this modification, then also your employer has to give you some sort of compensation. And if he terminates you, then also he has to give you some sort of compensation. So this compensation, whatever you opt for, that is nothing but your profit in lieu of salary. Next, we will look at Keyman insurance. So Keyman insurance is a insurance which your employer takes for you. Why? Because let's say, for example, you are no longer there in employment tomorrow, and there is a huge void which comes through because you are not in employment, and therefore the employer wants to be indemnified against that. And as a result of that, they go ahead and they take something known as Keyman insurance. So if you break this term Keyman into two parts, key and man, what do we understand? Key is something that's very, very important, right? We're talking about key from the point of view of importance and not lock and key. So you are an important person, okay? And this important person could be anybody. It could be a director of the company, or it could even be a peon in the company. So as long as you are a person of great importance for your place of employment, the employer can go ahead and take this Keyman insurance for you. So any sum which is received under a Keyman insurance policy, including bonus on such a policy, that would be treated as profit in lieu of salary in the hands of the employee. So when we look at Keyman insurance is something that features in different heads, depending on where and who is receiving it, right? So over here we are seeing it under the head salary. We will also again revisit this head when we discuss PGBP. And the same insurance will come when we talk about income from other sources, right? So how you are looking at this particular amount that is coming through from this insurance and in whose hands it's going, that will clearly determine under which head this income will fall under. Next, we've got certain retirement benefits. So you've got provident fund coming through to you, you've got gratuity coming through to you. In case of gratuity, we look at whether or not you're covered by the Gratuity Act or not. Then you've got commuted pension. So let's say, for example, you are supposed to get, let's say, 10,000 rupees per month, right? And 10,000 rupees per month is supposed to come through to you as your normal pension. But let's say, for example, you've got some sort of an emergency and you want money. Because you're no longer in employment, because you're a retired employee, what do? At best, you'll probably get some money or gather some money from your relatives, okay? But it's not coming out to be a huge amount. So you can probably go back to your employer and request that, well, can you now tap into this aspect of commuted pension? And as a result of that, what happens is that the employer, they usually take an account of how many years, there is a maths that is involved wherein they try and calculate how much of, roughly life expectancy is what that, they're looking at. So let's say you're a person who's 61 years old, okay, you have retired. So obviously they know that you have a long life ahead of you, right? Instead of a situation wherein you are perhaps 87, okay? And as a result of that, they will proportionately give you a chunk of money. But when they give you that large chunk of money as against your normal pension, what they do is that they are going to proportionately reduce your pension amount. So the whole point is that if they are going to give you that large chunk today, that amount of 10,000 that you were getting, that will get reduced, right? So let's say now instead of 10,000 a month, you are probably going to get only 7,000 a month, or you are going to get only 5,000 a month, right? Depending on how big an amount you are taking from the employer and what kind of life expectancy the employer sees of you. So that is when we're talking about commuted pension. So when you start getting, when you get that huge amount of money into your hand, which is a part of your commuted pension aspect, that also is to be treated as salary. Then we've got leave encashment. So sometimes you will accumulate something known as earned leave or privileged leave. So some places call it earned leave, some places call it privileged leave. So when you accumulate these leaves, you can have them encashed during your service years or even at the end of your service. So when you get that leave encashed, that means I was supposed to take leaves, I was entitled to take certain leaves, but I did not take those leaves, right? When I did not take those leaves, then obviously there is some way that, I can quantify that. And that is when we are saying that you're talking about leave encashment. So whatever amount of leaves I have accumulated, they will be encashed and that money will now come into my hands, right? So when that money comes into my hand, that is also known as is to be seen as a part and parcel of salary. Then we've got retrenchment compensation. So retrenchment is something that takes place when we are talking about essentially termination of services. Right? So whenever you are terminated from your services, you will get something known as a retrenchment compensation, and that is also to be treated as part and parcel of salary. Next, we've got voluntary retirement compensation, the VRS scheme. So some places of employment, not everyone, offers something known as VRS, which is your voluntary retirement compensation or voluntary retirement scheme, right? So when you avail of the voluntary retirement scheme, you get this amount which is to be given out as a compensation because you have opted for that particular scheme. And because of that, since you are getting it from your employer as an employee, because you opted for this VRS, you will have to see this amount that you're getting as compensation as a part and parcel of your salary. Next, we will look at allowances. So when we see allowances, these are basically coming to us in the form of cash, right? So you will actually see the inflow of money into your bank account, right? And a quick opposite of allowances are, far end of allowances are perquisites. Sorry. Okay. So on one hand, you've got allowances and on the other hand, you've got perquisites. Allowances, you would have commonly heard of terms such as HRA, TA, DA, etc. Those are nothing but allowances. So HRA is house rent allowance, TA is travel allowance, DA is dearness allowance, right? So all of these, what you hear of allowances, they usually come in monetary form. Not always, but usually it is in monetary form. So when these come into your hand, either they are fully exempt, or they are partly exempt, or they are fully taxable. Okay. So let's look at those situations wherein you are going to get complete exemption on the allowances. So first is when allowances are received by government employees for rendering their services outside of India. Next is the HRA, which is given to the judges of High Court and Supreme Court. Then we've got allowances which are received by the UNO employees. So if you are a permanent employee of the United Nations and you're getting allowances, those allowances are not to be taxed at all. Then we've got allowances which are paid to the High Court judges. And finally, we have the transport and sumptuary allowances which are given to the chairman and members of the UPSC. So now we've got this category of fully taxable allowances till now. So what we had seen just now were fully exempted ones, and now we're looking at the ones which are fully taxable. There are certain taxes which are absolutely taxable. So the first one is dearness allowance, additional dearness allowance, and high cost of living allowances. So dearness allowance is something which is given out to meet out inflation essentially, right? So because your salary does not go up as much, dearness allowance gets attached to it sometimes, right? So when it is attached to your salary, that means as your salary increases, your DA also increases. But at times that does not happen. Your salary remains as it is and also increases over time, but your DA is fixed. It will not move, right? So whether or not it is attached to your salary, that determines how you're going to get your dearness allowance in terms of how it is to be calculated. But irrespective, it is subject to tax 100%. Then we've got city compensatory allowances. Then we've got capital compensatory allowances, lunch allowances, tiffin allowances, marriage allowances, family allowances, deputation allowances, wardenship allowances, non-practicing allowances, project allowances, overtime allowances, fixed medical allowances, entertainment allowance, what we had discussed when we were discussing about deductions. And within entertainment allowance, we had discussed how you get the benefit only as a government employee. So this enlists exactly that it is fully taxable and no deduction is allowed irrespective of the amount spent. And B, entertainment allowance which is given to government employees, the least of the following is deducted from the entertainment allowance. So when you are going to get entertainment allowance as a government employee, we are not saying that it's not going to be taxed, right? You will get some deduction on it. Technically, it is fully taxable, but if you are receiving it as a government employee, then you will get some deduction on it. And what is the deduction? We say that we will look at the statutory limit. So over here it says rupees 5,000. Now the thing is that whatever numeric values you see across the board. So for example, you've got standard deduction at 50,000. Now standard deduction at 50,000 may change tomorrow, was different 10 years ago, right? So these numeric values will keep changing. Why? Because every year we have the Finance Act which comes in as a result of the budget that is passed. And because of that, these numeric values can be subject to change, right? So we are not going to really focus on the numeric values. We are not focusing on calculations, but we are basically looking at the principles behind it, right? So the first is the statutory limit of rupees 5,000, 1/5 of basic salary only, and third is the actual entertainment allowance received in the previous year. And what are we saying? That out of these three, whatever is the least of these, whatever is the least amount, that amount gets deduction, right? So taxable entertainment allowance is equal to allowance that is received minus the least amount. Then we've got water and electricity allowances, you've got servant allowance, you've got holiday trip allowance, etc. Now we will look at partially taxable allowances. So there are certain allowances wherein you get exemption depending on your actual expenditure that you have incurred. Okay. So let's look at these allowances. One is your traveling allowance, then you've got daily allowance, conveyance allowance, helper allowance, academic allowance, uniform allowance, right? So let us say, for example, you are working at a fast food joint, right? And you are supposed to wear a uniform. If you go to a fast food joint, usually you will see that everybody across the board is wearing the uniform of that particular fast food joint. And they are giving you, let's say, 2,000 rupees to go and get uniforms stitched. So the uniform allowance that you're getting is 2,000 rupees. And for this 2,000 rupees, they tell you that, well, this is our official vendor, go and purchase your uniform. And for every set of uniform, you need to spend 500 rupees. So what is expected of you? You are expected to go and buy 4 sets of uniform, right? Now you are somebody who feels that, okay, fine, I will go and I'll buy those 4 sets of uniform. So you go and you buy, and therefore, when we look at your uniform allowance, you have completely spent that uniform allowance. So you don't have to subject it to taxation at all. But you feel that I will not use or I will not purchase 4 sets of uniform. I can probably do with 2 sets of uniform. And because you are happy with 2 sets of uniform, what happens? The remainder amount of rupees 1,000 gets into your pocket. Okay. And when that rupees 1,000 gets into your pocket, that amount is subject to tax. Over here, there is no amount. Why? Because you fully exhausted that amount. Okay. Or let's say, for example, you exceed that amount. Okay. Because you feel that, oh my God, I cannot take care of 4 sets of uniform and then get into the whole problem of washing and cleaning. So I will take 5 sets of uniform. And because you have gone and got yourself 5 sets of uniform, how much of money have you spent? You have actually spent 2,500 rupees. That means 500 have actually gone out from your pocket, right? When you have given out 500 rupees out of your pocket, how much of tax are you supposed to pay on it? Nothing. Why will you? Right? Because you have gone and spent more, right? So that's how partially taxable allowances work. So there might be a situation where exemption does not depend upon the expenditure. So over here we were looking at how is it that you have spent that amount, right? But in the next category, it does not depend on how you have spent that amount, right? So the first is composite hill compensatory or high altitude or uncongenial climate or snowbound area avalanche allowance. So exemption is allowed from rupees 300 rupees per month to 7,000 rupees per month depending on the facts and circumstances. So let's say, for example, you are somebody who's living near Siachen. Then obviously your allowance will be way more than, let's say, for example, you're living in Shimla, right? So you can try and understand the magnitude or the degree of extremity that is involved. Next is border area or remote area or difficult area or disturbed area allowance. And exemption that is allowed is from this range. Then we've got compensatory field area allowance. Then we've got compensatory modified field area allowance. Then we've got counter insurgency allowance or compensatory field area allowance. High active field area allowance, underground allowance given to coal mine workers. So you've got people who are working in the coal mines and they do not come out for months altogether, right? So they are also given some sort of an allowance. Then you've got island duty allowance given to armed forces who are posted in Andaman and Nicobar Islands and Lakshadweep group of islands. And then you've got allowances which are given to the retired chairman and members of UPSC. Then we move on to perquisites, right? So allowance, you've seen that, there is some sort of money that is coming into your hand. But when you look at perquisites, which I told you is at the far end compared to allowances, in case of perquisites, these will come to you in kind, right? So allowances come in cash usually, and these come in kind usually, right? So exceptions are there at both ends, and therefore I use the term usually. So it may be in kind or non-cash form normally, but not all the time. Thus, sometimes cash can also be seen as a perquisite. Now, these benefits are given by an employer to the employee in addition to your entitled salary or remuneration. So, what is happening? You are getting a salary every month, right? Your salary slip looks something like this, right? With basic salary written on it. And then you've got, let's say, HRA, TA, DA, etc., etc., right? The list goes on and on and on. So you've got a whole set of allowances. But apart from those allowances, what happens is that your employer says that, okay, fine, this is what you're getting in hand, but I am happy to give you some more benefits. Okay. So when we join some sort of an employment and we go back home, we are usually asked that, what are the perks of this employment? So this is what we refer to and abbreviate as perks. Perquisites are abbreviated as perks in everyday language, right? So what are these perks? So let's say, for example, your employer says that, okay, fine, what you do is you take this accommodation over here. We have housing on board. Okay? So we have got a lot of houses which are vacant, which belong to the company or which belong to that particular enterprise. And therefore, you can utilize these houses, live here with your family, and that's it. Sometimes they can even offer you things like, we will take care of your children's education. Technically, who's supposed to take care of the child's education? The parent. But the employer says that, well, it's okay, we are going to take care of your children's education. When that happens, that's not a part of your salary, right? That's an add-on benefit that is coming, and that is nothing but a perquisite. So, these benefits are given to the employee in addition to the salary, right? Now, these benefits may be provided either voluntarily or under service contract. So, sometimes the employer will provide it voluntarily, or sometimes it comes as a part and parcel of your service contract. These perquisites must be vested and not contingent in nature for the purposes of being considered as a part of salary. So, when do we say that it is contingent? That means that if something is going to happen, if you apply or if you attach certain conditions to it, then we say that this is contingent in nature, right? But there might be situations wherein it is a vested amount which is given. That means irrespective of what happens, you are entitled to get this perquisite. So, what are the different kinds of perquisites which are there? We've got rent-free accommodation or sometimes accommodation at a concessional amount, both are included. Value of any benefit or amenity which is provided by the employer to the employee only in case of specified employees. The value of obligation of employee met by the employer. So, for example, you've got the children's education, right? So, obligation is of the employee, right? And they are saying that it's okay, we will come and we will take care of your child's education, right? So, that obligation is being met by the employer. Next is any sum that is paid to get an assurance over the life of an employee, which is a life insurance premium essentially. Then you've got any other fringe benefits. So, fringe benefits are small benefits, right? So, things like health club memberships, credit card expenses up to a particular amount. So, all of these are small benefits. Then you've got recognized provident fund or superannuation fund when the employer makes a contribution to that. Then you've got interest, dividend or any accretion on these, that is on the provident fund or superannuation fund. And then you've got the provision for sweat equity shares. So when the employee stock option plan is there and the employer offers to the employees shares at a nominal price, that also is to be treated as a perquisite. So let's look at this case of Ram Prasad versus CIT and followed by the case of CIT versus LW Russell. So what happened in Ram Prasad's case was that Ram Prasad was the SSE and he was working as a director in a particular company, right? And now the question was that could this director be considered as somebody who was an employee, in the sense that whatever amount of money he was getting, so this remuneration that he was getting, could that be considered as a salary or not? So when we have to find out whether somebody is getting a salary or not, what do we need to look at? We need to find out first whether or not there's an employer-employee relationship, right? To be able to find out whether or not there's an employer-employee relationship, what do? We look at the contract of employment, right? So when you're going to look at the contract of employment, that will tell you with utmost clarity whether or not there is an employer-employee relationship, right? Sometimes you will also have to look at the articles of association of a particular company. So over here, when the question came up whether or not this person was getting a salary or not, the remuneration could be considered as salary or not, the court first looked at the articles of association of that particular company, and the court found that, well, under the articles of association, this person could be removed from the post of a director if he was not actually meeting out his duties well, right? So therefore, if the employer could be removed, that means that there was this degree of control which was there by the employer on the employee, okay? Then the court went further and looked at the contract of employment, and over there too, the court found that there was a huge degree of control that the employer, that means the company, had over this employee, which was the director. And as a result of that, the court said that this remuneration that the director was getting, that could well be considered as salary. So it really depends whether or not a person is to be considered as, or rather it really depends on the contract of employment whether or not a person is to be considered as an employee or not. Only when there is an employer-employee relationship can we move on to the zone of finding out whether you are receiving salary or not. And then we move on to the case of CIT versus LW Russell. So in the case of CIT versus LW Russell, what had happened was that LW Russell was essentially an employee who was working with a British company, right? So when this person was working with a company, there was a scheme which was given out, wherein there was this amount that was to be given out, right? So there was a society that he was working for, and this particular society had established a superannuation fund, right? Now, when the superannuation fund was there, it was provided that the society will give 1/3 the amount, right? And that 2/3 amount will come from the employee, okay? And this entire superannuation fund, that was to be used for the purposes of pension. So this was to be used for pension, but there was a contingency that was applied to it. So the contingency was that, well, if you are going to cease to be a member of the society, either on account of death or otherwise. So otherwise would mean what? Otherwise would mean that, well, you are not going to be in employment with them anymore, right? Then if you cease to be a member of the society on account of death, then the amount which is contributed, by the society plus the interest, that will all go back to the society. And if it is otherwise, then also it will all go back to the society. But this will come to you only and only when you reach the age of superannuation. So if you want to get this entire amount that you have put in, or this entire amount that you are entitled to, so called, you will get it only at the age of superannuation. That means at the time of retirement. But over here, there was a contingency that was applicable. And because this contingency was applicable over here, the court said that this perquisite of contribution which came through from the society for the superannuation fund of the employees, that was not a vested one, and because it was simply a contingent one, it could not be considered as a perquisite, right? So if you go back and you recall, we had discussed that for a perquisite to be considered as a part and parcel of salary, it must not be a contingent one, but rather a vested one. So with this, we wrap up the head of salary, and I hope that you have been able to understand this head of salary with greater clarity, and we will perhaps make reference to this head salary as we move on to other heads of income as well. Thank you.
Hello, good morning everybody. I am Raghunandan Sengupta. So, I will just give you a very brief excitement area of finance, which is quantitative finance, and that has a huge market starting around about 10 years back, and it is exploding exponentially. So, what do we mean by quantitative finance? Quantitative finance is actually the application of different mathematical and statistical techniques in the area of financial markets, be it say for example derivative pricing, be it in the area of say for example portfolio management, be it in the area of asset liability management, be it in the area of portfolio management. We see that the application has exploded in such a way that there is a huge opportunity for people who have a quantitative background in mathematics and statistics. They can utilize those in the area of finance, but obviously with some prior knowledge of finance as a subject. Now, when we say about quantitative finance, as I said, it is an area of applied mathematics and statistics applied in financial markets. Use of different areas, if somebody is interested to know, we have stochastic calculus, we have derivative pricing, we have operation research, we have quantitative techniques like differential equations, stochastic calculus, time series, and they are heavily used in the area of quantitative finance as I mentioned. Now, we all know that in 1997 the Nobel Prize in Economics, so it is basically the Nobel Memorial Prize in Economics was given to the work of Merton and Scholz in the area of derivative pricing, and after that there has been exponential increase in the area of quantitative techniques in quantitative finance and in the area of different type of derivative pricing. With the advent, moreover with the advent of high-ended and sophisticated computing data, big data has come in a very big way, where application areas starting from computing, from different type of algorithm design have been taken up in such a big way that nowadays at least we are able to understand that how high frequency data algorithm trading can be utilized using the concept of quantitative finance in the area of finance as such. But there is a flip side also, obviously when there is a huge amount of development. So, obviously due to some regulation errors or something, there has been some pitfalls, which I think should be a bullet point for people who are really interested to take up quantitative finance. They should be aware. So, consider the financial crisis in 2008 and later on, and we are seeing different banks are failing, different financial institutions are facing a problem, countries are facing a problem like in Europe, in USA. So, what should be done? So, the main thing is that even if you know the technique is best for people who are investors, who are private players, organizations like banks, governments should use these techniques in a very somber manner, such that the application areas of quantitative finance using the techniques which we learned can be utilized in the best possible way to garner the overall the in-depth knowledge a person has in trying to utilize these quantitative techniques in finance. and I am sure that people who have the background, who have the knowledge, who have the sophistication, who have the knowledge of the society can definitely use quantitative finance in a very big way in trying to make their mark in this exciting field, which you are going to see in years to come. And I am sure it will be a very exciting learning tool for all the participants who will take quantitative finance as a subject in years to come. Thank you, and I wish all the participants all the best and best of luck for the programs they will take. Thank you.